Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The private credit industry has grown enormously in the last decade, tripling to around $1.5 trillion US dollars at the start of this year. It's forecast to hit $2.8 trillion by 2028, although some fund managers, like investment giant BlackRock, say it could get to $3.5 trillion. Locally, it's taken off, but the global private market is much larger and very different to private credit here. Today, we're going to find out how they're different and how local investors can gain access to the global market. Remember, this is general information only. You should seek professional advice before making investment decisions. Nehemiah Richardson is the Chief Executive Officer of Pengana Credit, a supporter of this podcast. Pengana, in association with Mercer, recently launched a listed investment trust, the Pengana Global Private Credit Trust, along with online term accounts, Term Plus, to provide fixed income from global private credit investments. Nehemiah, welcome to Fear and Greed.
Thank you very much, Sean. I appreciate you having me here.
So you say comparing local and global private credit is like comparing apples and oranges. How so?
Yeah, so I guess what it really was referring to there is that whilst the private credit markets in Australia and globally, when we say global, what we're specifically talking about at Pengana is the US and Europe. And what we're referring to is whilst there's bank regulation that has been imposed on banks here as well as offshore in the global markets that have really sought to reduce the risk that sits within banks, to help protect, the financial services industry and to help protect, in particular, deposit holders. Now, the reasons why that has occurred and the ways in which that has actually been prosecuted by bank regulators has been different in Australia and globally for a number of different reasons. And in particular, when I say apples and oranges, so that's similar. What's different in the apples and oranges side is the drivers of bank regulatory changes in the US and Europe were very different than they were in Australia. In the US and Europe, post the GFC, and if you recall, the GFC was both a credit crisis in the subprime mortgage market, predominantly, and a liquidity crisis where people wanted to withdraw cash out of banks, and banks had to be able to liquidate assets in order to pay people their deposits. Now, one of the things that actually happened as a result of that, and in order to improve financial system stability in the US and Europe, the regulators wanted to ensure that the banks no longer ran these big mismatches between at-call deposits, which then funded longer-term loans, and in particular, corporate loans. Mm-hmm. Okay, so corporate loans would have a duration of sort of 3 years to 5 years and maybe up to 7 years. So, of course, if someone wants to rip their at-call deposit out of the bank, you can't sell a 3-year loan very easily that sits on a bank balance sheet. Okay, in Australia, you had a different phenomena where we're very well regulated. The liquidity side of things is much better managed in Australia, and therefore the way that the regulators have sought to kind of protect the system, if you will, is to impose capital requirements on banks that meant banks are very disincented from lending into certain types of asset classes.
So the capital rules overseas are different to the capital rules here when it comes to this sector.
Yes, and I guess the way of putting it is capital rules, the methodology around how you look at the capital rules is broadly similar. The way that they were applied is what actually creates the differences. So, for example, in Australia, what you'll find is the private credit market is actually participating where banks don't have risk appetite. And some of that is because of the increased capital requirements, meaning they have to hold more capital for every dollar that they actually lend into those markets, that being predominantly commercial property, subordinated positions in asset-backed vehicles, and sort of large, highly leveraged M&A transactions. That's predominantly where you see the private credit managers in this country participating. And the other fact is, in Australia, about 90% of all credit is underwritten by the banks and 10% by private credit managers. And that 10% is concentrated into those asset classes predominantly.
So in the US and Europe, is it broader in the US and Europe?
Yeah, so in the US and Europe, what you'll find is because they really wanted to get rid of that mismatch between those at-call deposits and longer-term corporate loans, basically what used to sit on bank balance sheets and what banks would still today be happy to underwrite is loans to mid-market credit, but the problem, mid-market companies. But the problem is they now have to hold more capital against that, so they get a lower return on those assets, and therefore no longer have a big disincentive to lend to mid-market companies, being companies that are about $1 billion to $3 or $1 billion to $5 billion in size. Now, what has then happened is asset managers emerged, funded by institutional investors, to kind of step in and fill in that gap. So what you have in the mid-market of the US and Europe is about 85% of all lending to those companies is done by private credit managers, and 15% is done by banks. And that divide, or that structural gap, if you will, continues to grow, particularly after what you saw in 2022. In Silicon Valley Bank, Credit Suisse, you had these major bank failures, which then kind of caused regulators to go further in terms of the types of assets that they want to get off bank balance sheets and put into the private credit system for system stability and safety purposes.
Stay with me, Nehemiah. We'll be back in a minute. I'm speaking to Nehemiah Richardson, CEO of Pengana Credit. Okay, so let's bring that back to investors here. So I'm with you so far. The point there then, if you're running a global fund, as you guys are, suddenly the assets that can be involved are greater than potentially in Australia, or at least more mixed, shall we say. I mean, I know that you talk about the greater accessibility for all investors, and I know you're talking more specifically about you don't have to be an institutional investor to get involved in that, and I kind of want to get to that point there. But even just the asset classes that you're talking about when you're investing globally is broader, which of course is helpful in a diversification sense.
Yes, correct. And one of the great things about global private credit is that you do have this very wide diversity. So, for example, many of the companies that you'll see in portfolios, particularly these corporates, will be very defensive in nature. So you have a big supply-demand gap. It means the private credit manager can decide where they want to play. And so where do they play? They go and try to find defensive companies. And what does that mean? That means in non-cyclical industries, essential services, so that the predictability of the income or the predictability of the revenue that's actually earned by these companies is very solid. Okay. Secondly, they look for companies that have market-leading positions, very long-term contracts, those types of things that are very defensive in terms of sustainability of cash flow, flexible cost bases. So if the revenue starts to actually be under pressure, they have the ability to, very quickly scale down their cost base to, at the end of the day, generate, predictable cash flows to pay the interest and to repay the loans. Now, the other thing that's really important here when we say defensive is you're talking about, information technology industries where you have sort of B2B, software companies. So software companies that, for example, provide, essential software to run big companies and that are very hard to kind of transition out of once they're in those companies. So those are the kinds of characteristics that you'll see. Secondly, you generally won't see them in the same type of commercial property type exposures as you see here. So we don't invest with managers that, that would take big development risk as an example, or big office risk. So, because they're such large markets, because there's the biggest supply-demand gap, the managers can pick and choose where they actually want to play. And as a result of that, generate better returns with lower losses than you would find, even at banks.
Okay, so I'm going to slightly argue against you. When you talk about the need for simplicity in this, isn't what you're talking about potentially making it less simple?
Yes, well, I think the thing about simplicity is, firstly, what I'd start with is private credit is actually no different to the business of banking. Private credit's been around forever, right? The notion of lending money to a company to allow that company to grow has been around for a very long time. And the way in which that's actually prosecuted been around for a long time. Now, one of the things that we actually sought to do is, with the myriad of choices, the myriad of managers, et cetera, and the myriad of choices that there are for institutional investors, not so much for retail investors, what we've sought to do is to really simplify that in our partnership with Mercer. So what we've gone out and done is specifically sought to identify and invest with managers that do bilateral loans to these mid-market companies, so those $1 to $3 billion, do that in bilateral contracts, so financial contracts that cause the borrower to have obligations for repayment, for payment of interest, repayment of capital. They come with information rights for the manager, so the manager is able to effectively monitor the performance of the company and intervene if it gets off track in order to protect the income and protect the capital, and also have ownership or the ability to exercise security rights, which allow them to sell assets on the balance sheet or take control of the company and sell the company to get their money back if things go wrong. So that is a very simple sort of notion, has been around for a long time. Very complex if you don't actually have somebody who can pull all that together, identify the managers in those spaces, and create vehicles that allow investors to access the asset class and what it has to offer. And that's what we've really sought to do, is to say, well, if you're going to go buy a bank, say a bank term deposit, or if you want to buy a bank hybrid, all you're really doing is buying a package of the money that the bank has lent to customers, earn some income, and they pay that out to the various types of investors who invest in their instruments. We've actually done the same thing. We've built a portfolio of top-rated managers who play in very defensive parts of the private credit space in the US and Europe. They generate income that then actually supports the yield payments to investors, as well as ensure and manage to get their capital back.
And as the List Investment Trust, the Pengana Global Private Credit Trust, it's accessible with smaller amounts of money, the point there too. So I don't know about me personally, Jeremiah, but people like me can go and put tens of thousands of dollars in. You don't need to be putting millions in.
Yes, precisely. And what we're very excited about, I'm glad you said that, Sean, is what we're really excited about is we've really launched two products to, in effect, try to democratize the access, right? Because you have institutions who can go and do this, and manage it on their own, but it's very difficult, obviously, for the likes of you and me to be able to do that without the infrastructure and the resources, et cetera, to be able to be able to identify and invest. So we've actually done two things. So one is our listed trust, which provides access to investors. You can go and buy it on the ASX. And we also make it quite easy if you don't want to trade out of it on the market, because for whatever reason, if this traded at a discount to the underlying net asset value of the assets in the fund, every quarter we will make off-market buyback offers to investors for up to 5% of the outstanding units, where if you tender into those buybacks, you're able to retrieve your capital at the net asset value at that time. The other product that we've actually released, which we're extremely excited about, is a term account product. So the product that we call Term Plus. And what that was really born of was, well, you have a great asset class that's generating really nice returns that are actually very stable and managed by managers in a way that, seeks to minimize loss. And I guess to give you a proof point, if you look across our senior direct lending managers in our portfolio, their average net loss rates, since the GFC are 20 basis points, or 0.2%, which is, some of them have actually been zero over that period of time. So very, very defensive, very stable, attractive assets. Now, what we've done is we've been able to kind of take that and say, okay, if you take a clean sheet of paper and you look at all the sort of term account products that are available for investors to invest in, how could we create something that could deliver those attractive features to investors? So our minimum balance, the minimum investments we would require is $2,000 on that. But it's very quick and easy and compliant onboarding online. You get a floating rate of return that kind of moves with movements in the RBA cash rate. So it would have been, if you think about the interest rate rises over the last 18 months, a great hedge against inflation. You can take your income monthly, or you can reinvest it and compound it at the target rate. And it really is just aiming to provide that stable income. One of the other things that we've done with the product, right, and you have a choice of 1, 2, and 5 years, is we've not only do you have the defensive characteristics of the asset class, we've also built in additional protections. And what that means is we invest 5 cents in what we call a support account. So every dollar we get from an investor, we will invest 5 cents ourselves in a support account. And what that does is it helps to support the payment of investors' income, and it also supports repayment of their balance at maturity, in certain circumstances if things, for whatever reason, don't go to plan. And so we kind of feel like with the defensive nature of the asset, with those other built-in protections, there's a really attractive alternative available to investors looking for sort of 1, 2, or 5 year, and with a lower balance, like a minimum of 2,000, it does make it much more accessible to the average investor.
Well, Nehemiah, good luck with it, and thank you for talking to Fear and Greed.
Okay, thank you very much for your time.
That was Nehemiah Richardson, CEO of Pengana Credit, a supporter of Fear and Greed. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.